Hi everyone. Today, we're going to delve into a crucial aspect of auditing, assertion concepts. As auditors, we rely on these concepts to ensure the accuracy and reliability of financial statements. Let's begin by understanding what assertions are and why they're essential in our work. Assertions represent the implicit or explicit claims and representations made by management in financial statements. They serve as the foundation for our audit procedures, guiding us in evaluating the completeness, accuracy, and validity of the information presented. There are several types of assertions categorized into two main groups: management assertions and audit assertions. Management assertions. Existence or occurrence. Assets, liabilities, and transactions exist and occurred during the reporting period. Completeness. All transactions and accounts that should be presented are included in the financial statements. Rights and obligations. The entity holds legal rights to assets and liabilities are obligations of the entity. Valuation or allocation. Assets, liabilities, and transactions are recorded at their appropriate values. Presentation and disclosure. Financial statements are properly presented and disclosed according to applicable accounting standards. Audit assertions. Assertion of existence. Assertion of completeness. Assertion of rights and obligations. Assertion of valuation and allocation. Assertion of presentation and disclosure. Why are these assertions important? Assertion testing allows us to obtain sufficient and appropriate audit evidence to support our opinion on the financial statements. By systematically assessing each assertion, we can identify potential misstatements or fraud risks, providing assurance to stakeholders regarding the reliability of financial information. There are various techniques we employ to test assertions, including inquiry and confirmation, observation, inspection of records and documents, reperformance, analytical procedures. Assertion requirement: for each sales transaction, the following assertions should hold true. Valid customer: the customer associated with the transaction exists in the customer database and is active. Product existence: the products being sold in the transaction exist in the product database and are currently available for sale. Transaction total calculation: the total amount of the transaction is accurately calculated based on the quantity and price of each product. Discount application: if any discounts are applied, they are valid and correctly reflected in the transaction total. Tax calculation: the appropriate taxes are calculated and applied to the transaction total according to the applicable tax rates and regulations. Payment confirmation: there is confirmation that the payment for the transaction has been received and processed successfully. Inventory update: after the transaction, the inventory levels of the sold products are appropriately updated to reflect the quantity sold. Transaction record: a complete and accurate record of the transaction is created and stored in the sales database, including details such as transaction ID, date, items sold, customer information, total amount, and payment method. These assertion requirements ensure that each sales transaction is properly handled, recorded, and reflects the correct state of the business's inventory and financials. In conclusion, assertion concepts form the bedrock of our audit procedures, guiding us in evaluating the accuracy and completeness of financial statements. By understanding and testing these assertions rigorously, we fulfill our responsibility to provide stakeholders with credible and reliable financial information.